Hey, what's up guys, John here. Roughly 20% of all commercial real estate loans in America have to get refinanced this year.
The risks of commercial real estate loans on bank balance sheets.
$1.4 trillion of commercial real estate debt coming due in the next 18 months.
And the damages could topple a whopping 231 banks over the next 10 months. They believe that this crisis will be and could be far worse than the great financial crisis in 2008 if the Fed does not pivot. But if you look at what happened with the CPI report, the jobs report, look at what's going on with inflation, you're going to see very, very clearly that a Fed pivot might not be in the cards anytime soon.
I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting. Probably not the most likely case, or what we would call the base case.
And because of this, we could be walking into a massive, massive rug pull inside of the U.S. economy. Now, during the hard times, great fortunes are made, just like in 2008, 2009. I believe the next year or two will be no different. We will see many people create an absolute fortune inside of the chaos. And in this video, I'm going to break it down and show you exactly what they are saying, exactly who is exposed. It's not just the banks. It's not just Wall Street. This is pension funds, retirement funds. This is Main Street. This is America that's at risk. I'm going to break this down. Please hit the like button. When you hit the like button, YouTube will share the content, educate more people about what's going on in the U.S. economy. And if you'd like to fix your credit to position yourself for this massive, massive wealth transfer, this massive opportunity, we would love to help fix your credit. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item on your credit report, go to greatcreditfast.com. Click the link in the description just below this video. Schedule a free strategy session for Monday. Take a look at this. So, will empty offices cause the next banking crisis? Commercial real estate debt bomb of $929 billion comes due this year, with hundreds of banks facing insolvency runs if default rate loans spike. Now, they say about 14% of all CRE loans and 44% of office loans appear to be underwater, meaning they owe more than the buildings are worth. Some $929 billion of outstanding commercial real estate mortgages held by lenders and investors will mature in 2024, or 20% of the $4.7 trillion total outstanding debt, according to recent data from Mortgage Bankers Association. Meanwhile, higher interest rates are battering commercial real estate, CRE property values. Now look at this. If nothing changes, if interest rates remain elevated and property values do not improve, we do view defaults at the rate of the Great Recession, and in fact, higher, as quite a possibility on, this is one of the co-authors at Columbia Business School, right? And so here's a really interesting deal right now. This is City Hall in Philadelphia. This is 1515 Market Street. And so, I mean, this is a trophy property in a great location. And they were pulling in $6.6 million in net income in 2014. Now it's bringing in $4.4 million. Now, when you look at what's happened with interest rates over the last several years, and you look at what's going on with insurance and taxes, you look at the vacancy rates that are continuing to grow inside of Philadelphia, inside of major cities, Los Angeles, San Francisco, what is this going to do? It's going to pummel the actual property value here. And so this building, this deal is probably going to, it's already back to a special servicer, right? So they're already, it's already going back to the lender. Today's CRE collapse, Philadelphia 1515 Market Street put into special servicing with $59.4 million left on the mortgage. You have this deal here. This property, mortgage, the Montgomery Park office building, sold for $37.7 million. 3 years ago, it sold for $255 million. Now, generally on these deals, people put down, investors, they'll put down 30%, maybe 40%. So on a $255 million deal, maybe they put down $80 million, right? And they finance the rest. The bank is getting absolutely crushed on this deal. Now imagine the scale of this. 20% of all mortgages on commercial property, think multifamily property, think office buildings, all commercial debt, 20% of them, they're in really big trouble. And when you have a small pool of buyers that will actually step up and buy these properties, what's going to happen? Right? You're going to see large institutional players stepping in, buying this debt. Right? They're going to start buying these deals. And I think we're going to start seeing, here's another good example. Chicago, this deal sold for $4 million. And in 2012, it sold for $51 million. $51 million 14 years ago, and it just sold 2 months ago, or last month rather, for $4 million, right? So look at this. Who holds commercial mortgages? 47% are banks, right? 47% are banks. Now, for context, 70% of those loans are held by small, local, and regional banks, right? Smaller lenders, 70%. The rest is, you have commercial mortgage-backed securities, and when you look here, pension funds like to invest in commercial mortgage-backed securities. Unlike the average consumer, large pension funds rarely take a hands-on role investing in the industry. Rather, investors choose from a menu of real estate investment vehicles, companies, and strategies available to allow them to participate passively. In the public markets, investors can allocate funds, real estate investment trusts, REITs, and commercial mortgage-backed securities, right? They have 1.5 trillion, U.S. pension funds worth 1.5 trillion at risk through leverage. Then you start just looking at all this. You have non-bank lenders, life insurance companies, government-sponsored enterprises. So when you start to really kind of tally this up and you start to really pay attention to the markets that are going to be exposed, and you look at some of the changes that are unfolding in the economy, all of this is coming to a head at one time. Now, if we have a situation like what we're having right now with record high inflation, where Americans can barely, make it from paycheck to paycheck, what I believe is going to happen is as we start to see a lot of markdowns on these office buildings and the tax revenue gets greatly depleted because the tax base is based on the value of the asset. Now, if the value goes from, $51 million to $4 million, the tax revenue has basically been, brought down 80%, right? And so what does that mean? Less money for schools, social services, for, street cleaning, for police departments, all of, the operating entities inside of that city that are funded by tax revenue get hit. And so when you have a situation where 20% of all debt in a commercial property has to get refinanced this year, and a lot of these loans are underwater, what do you think is going to happen? You have a rise in demand for social services and a depletion in tax revenue. So we're walking into something really interesting here. Now they say here that 231 banks says if default rates on CRE loans jump to 10%, the study estimates that 231 U.S. banks with aggregate assets of $1 trillion would see the market value of their assets fall below the value of their customer deposits. Now, they brought this article out last year in March. U.S. banking crisis closed up to 190 banks could collapse, right? So they put this out about a year ago, ballpark. And now they're saying 231 banks. I personally would be shocked if we didn't see more Silicon Valley Bank, Signature Bank, First Republic Bank types of situations unfold over the next 6 to 12 months. I would be absolutely shocked. That situation could spur panicked customers to withdraw their unsecured deposits in the same kind of rapid run triggering the collapse of Silicon Valley Bank last year. Because of high interest rates, there are dozens to hundreds of banks that are on the brink of solvency. This additional commercial real estate distress puts them into the group of banks that potentially are susceptible to runs by depositors. This is the icing on the cake that can really create a problem for quite a few banks, mainly smaller mid-sized banks. Now you have Kevin O'Leary coming out saying, avoid small regional banks. You have a lot of people coming out saying that small regional and local banks are in great risk. And then you have larger players like JP Morgan Chase that are running out there. They're opening up new branches. They're hiring a lot of employees. They're renovating branches. They're getting ready for this massive expansion because they know that regional banks are doomed. He wrote in a recent column for Daily Mail. Others fear contagion from a possible banking crisis that could threaten the broader financial system. A recent report from a financial regulator established in the wake of the Great Recession listed commercial real estate market as the first among the risks to the economy. Now, they ask, why are commercial real estate values down? Interest rates have risen, carrying costs have risen, taxes and insurance, and rents are softening, and vacancies are continuing to climb. Now, what they say here is explaining the current solvency risk to banks. Interest rate hikes over the past 2 years have reduced the aggregate market value of U.S. bank assets by $2 trillion. This has put dozens to hundreds of smaller banks on the cusp of having assets that are worth less than what they owe depositors. A 10% default rate on CRE loans would wipe out $80 billion in asset value off the bank's balance sheet. While that number is smaller relative to total bank assets for some 231 banks, it could tip the lenders into technical insolvency. Those 231 banks would be at risk of failure if they face bank runs by uninsured depositors seeking to move their money. So you just look at the writing on the wall. You see these trophy properties in prime locations in basically every single major market in America walking into the same exact problem. You're seeing depositors and people that have money in banks looking for a higher yield on their money, they're looking at, what the banks offer and 0.01%, and then they're saying, hey, treasuries are paying 5%, and I can go get a CD, I can get, X% here, I can make a lot more here. People are looking to make more money to offset the cost of inflation, which puts more pressure on the banks. And then on top of that, a lot of the loans in which banks have issued over the last couple of years are not working out to the likes in which, they intended. Look at car loans. Car loans are at a 30-year high right now. Mortgage applications are down. They're making less money across the board. They're seeing defaults rise, deposits, moving, and their loans are really in a really bad situation. I do believe what we're going to start to see here is the big banks are going to get a lot bigger, and we're going to see a lot of people, walk into some hard times. And inside of the hard times, always remember that there's always somebody making a lot of money. Right? There's always somebody that's going to be making a lot of money. I believe that there's going to be a lot of people, a lot of everyday Americans that are going to make a lot of money in this. There's going to be a lot of everyday Americans that don't, right? But at the end of the day, the people that are taking action, the people that are educating themselves on what's really happening and positioning themselves accordingly to put themselves in this position to be able to make that next move and to achieve their goals are going to be the ones that actually do. What are your thoughts about this? Drop below, have a conversation about it. If you'd like to fix your credit to position yourself for funding, if you're thinking about investing in distressed real estate, we'd love to help you. Maybe getting a business loan, buying a business. Put your credit score in line with your goals. So if you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item in your credit report, go to greatcreditfast.com, click the link in the description just below this video, schedule a free strategy session for Monday. Catch you next video.